$94 trillion. And that single step up is the kind of number that should stop you cold. That's not a stock price. That's the balance sheet of the world's monetary authorities. And inside that mountain of reserves, the map of what counts as safe is shifting faster than most people are prepared to admit. Not months, not weeks. In 48 hours, one technical update from the world's most important reserve data set changed how the story is told, and it exposed something most commentary had been smoothing over for years. They said the dollar's dominance could not be meaningfully challenged. They said there was no alternative. And yet, right now, the alternatives are not arriving as a single replacement. They're arriving as a system. For decades, the dominant assumption was simple. The dollar is the center, and it stays the center because nothing else can match the scale, liquidity, and trust that sit behind it. And in a narrow sense, that's still true. The dollar remains the largest reserve currency. The dollar still anchors global risk pricing. The dollar still sits inside the deepest government bond market on Earth. But here's the part most people miss. De-Dollarization doesn't require the dollar to lose first place. It only requires the margins to change. It requires fewer dollars needed to clear trade. It requires fewer dollars held as precautionary reserves. It requires more settlement routes that don't pass through a single gate. And the data shows those margins are moving. Institutions already know this. You can see it in what central banks are accumulating. You can see it in how trade partners are settling. You can see it in what payment rails are being built quietly, as if the future will be more fragmented than the past. In the moment that fragmentation meets a real stress event, what looks slow can compress into a shock. What I'm about to lay out is not opinion, it's pattern. And once you see the pattern, the headlines start to look late. Welcome to Data Before Headlines, where we decode what the balance sheets and the plumbing reveal before the talking points arrive. If you like calm analysis instead of takes, you're in the right place. Consider subscribing if you want to keep pace with these signals. And drop a comment with where you're watching from, because the map matters in this story more than people think. Now, what actually happened? The IMF's COFR dataset is one of the cleanest windows into how central banks diversify. In 2025, the IMF began changing the way COFR is presented, moving toward a complete currency composition rather than leaning on a large unallocated shadow. Starting around 2025 Q3, with revisions back to earlier years, the IMF shifted the framework, so the published composition accounts for 100% of global reserves by imputing the missing portion. That sounds technical. It isn't. It changes the quality of the signal, and it makes the drift harder to dismiss. At the same time, the quarterly snapshots were telling a very specific story. Total reserves were rising, but the distribution underneath was not standing still. 0.9% in 2025 Q1, 12%. Those numbers are not dramatic on their own. The drama is in what they imply. Diversification is happening across a basket, not into a single successor. That is how a multipolar system is born. And here's the contradiction that sits at the center of the mystery. If the dollar is still dominant, why are official actors behaving as if single-point dependence is a risk worth paying to reduce? Why is gold, an asset with no issuer and no counterparty, rising in the official reserve hierarchy? And why are bilateral settlement channels multiplying at exactly the same time? This is where it gets interesting. The mainstream story treats de-dollarization like a dramatic event, a summit, a declaration, a sudden collapse. But reserve regimes don't change like that. They change the way coastlines change, millimeters per day until the map looks unfamiliar, and when a stress event hits, those millimeters become the difference between a smooth settlement and a scramble. We've seen this playbook before, and the pattern is almost uncomfortable in how consistent it is. In 1914, the world did not announce the end of Britain's monetary dominance. It drifted. War financing expanded debt. Trade routes shifted. Balance sheets weakened. Alternatives grew. The pound remained used, but the marginal decision-making moved elsewhere. The shift was visible only in hindsight, because the transition was quiet until it wasn't. In 1944, Bretton Woods did not begin with a crash. It began with coordination around a new reality. The United States had the industrial base, the gold, and the ability to underwrite a global framework. Again, the shift was structural. Trade invoicing, commodity pricing, payment networks, safe asset demand. In 1971, the world remembers the break because it was sudden. Convertibility ended. But what followed was still a process. The dollar's dominance deepened through markets, not speeches. Eurodollar funding expanded. Treasuries became the core collateral of global finance. Oil and commodities were priced in dollars. The network effect became self-reinforcing. That's the point most people forget. Dominance is not just about reserves. It's about settlement and collateral. Now fast forward. In 2008, the global crisis exposed how quickly dollar funding becomes scarce when confidence cracks. In 2020, the dash for dollars repeated the lesson under different stress. Each time, The Federal Reserve's swap lines reminded the world that the dollar is not just money, it is a gate. If you are inside the swap line network, liquidity arrives when it matters. If you are outside, you scramble, pay up, or improvise. That asymmetric access is one of the strongest incentives to build redundancy. So, who is positioning right now? Start with central banks, because they cannot afford ideology. Their job is survival. In 2024, central banks bought 145 tons of gold, the third straight year above 1,000 tons, 3 tons. That is not the behavior of a system that feels perfectly comfortable with its single anchor. It is the behavior of a system paying for insurance. Then look at what Europe's own central bank highlighted. By the end of 2024, the share of gold in total official reserves rose to about 20%, surpassing the euro, which was around 16% in that framing. Gold doesn't compete by offering yield, it competes by offering neutrality. When gold climbs in the reserve hierarchy, it's a signal that trust is being reweighted. Now add the settlement layer. Russia and China have described mutual settlement in rubles, and yuan exceeding 95% for their trade transactions. Again, this isn't about applause lines, it's about mechanics. When two major trading partners can clear the bulk of their flows without dollars, that directly reduces the marginal demand for dollars as a trade lubricant. It doesn't have to replace the dollar globally to change the shape of the system. Brazil and China have also renewed local currency swap arrangements on the order of 190 billion yuan, alongside broader cooperation on settlement frameworks. These numbers matter because swap lines are not philosophy, they are operational capacity. They are a bridge that lets trade keep moving when a currency market is stressed. And there are quieter movements that don't fit neatly into a headline. Countries building regional payment systems, firms experimenting with invoicing in non-USD currencies, multi-currency trade finance structures, trials of new settlement technology. The BIS has been explicit that inefficient cross-border payments contribute to a fragmented global financial system. That line is important because it frames the issue. Fragmentation is not a theory. It is a risk that institutions are already planning around. Now, the dislocation. One dataset says the dollar is still the reserve king. Another says gold has risen to a historically significant share of official reserves. Another shows the other currencies bucket expanding. Another shows major trade corridors settling outside the dollar. These signals look contradictory only if you expect the world to flip from one pole to another overnight. The reality is messier, and that mess creates dislocations. Here is one of the most important dislocations: the difference between the currency of pricing and the currency of settlement. A commodity can be priced in dollars and still be effectively settled through a chain that reduces dollar usage. An importer can use a local currency swap, convert into the exporter's currency, and hedge the exposure through non-USD instruments while the global screen price remains in USD. From a distance, it looks like the dollar is unchanged. Under the surface, the demand for actual dollar liquidity can be lower. Another dislocation is between paper markets and physical constraints. In many markets, the paper representation of liquidity can look deep until the moment physical. Settlement is demanded at scale. Gold is a clean example because it sits at the intersection of finance and physical custody. When official actors buy gold, they are not buying a promise from another government. They are buying a reserve asset that can be held outside foreign jurisdiction. That preference grows precisely when geopolitical and settlement risk rises. A third dislocation is geographical. Liquidity is not evenly distributed. In a more multipolar world, the same asset can carry different premia depending on where you are and which rails you can access. That can show up as wider spreads, more basis risk, and sudden repricing when one region's funding becomes scarce. This is the part no one likes to say out loud. Multipolar systems are usually less efficient than unipolar systems, at least at first. A single dominant hub is convenient. It concentrates liquidity. It standardizes contracts. It reduces friction. A multi-hub world adds redundancy, but it also adds complexity. And complexity has a cost that markets eventually have to price. To understand why this matters, you have to zoom in on the decision makers. Reserve managers are not chasing returns. They are minimizing failure modes. They ask 3 questions. Can I use this asset in a crisis? Can I mobilize it quickly? And can someone else prevent me from using it? For decades, the answers pointed back to dollars and treasuries because the market depth was unmatched and the settlement network was everywhere. But the last decade added a new variable, jurisdictional risk. If access to reserves can be restricted, delayed, or politicized, then a portfolio optimized only for liquidity is no longer optimized for survivability. That is why the institutional movement is so revealing when you name the actors. The IMF is publishing the composition. The ECB is highlighting that gold's share in total official reserves rose to roughly 1/5 by the end of 2024, overtaking the euro in that framing. The BIS is warning that friction in cross-border payments can fragment the system and make shocks harder to absorb. And the World Gold Council is tracking a run of central bank buying that would have sounded implausible 10 years ago. 3 straight years above 1,000 tons, followed by another year still deep in the high hundreds. Different institutions, different mandates, a similar direction. Notice the timing. Gold's reserve share rises not only because of purchases, but also because the price rises. That creates a feedback loop. A higher gold price increases the value of existing official holdings, which raises gold's share in reserves even if purchases slow. Meanwhile, COFR can show the dollar share drifting lower partly due to valuation effects, even if central banks are not dumping dollars en masse. 2 data sets can tell 2 different stories and both can be true. The story you need to hold is the combined one. The system is diversifying and the diversification is becoming measurable in more places. Now let's make the dislocation concrete with a simple example. Imagine a country that imports energy and exports manufactured goods. In the old model, it earns dollars from exports, pays dollars for energy, and holds dollars in reserves as a buffer. In the new model, it signs a local currency swap line, invoices a portion of trade in partner currencies, and holds more of its buffer in a mix of gold and other currencies. On paper, global contracts may still reference the dollar. In practice, the country needs fewer dollars to keep trade moving, and it has more options if access to dollars becomes expensive. This is also where financial plumbing shows up in places people don't associate with geopolitics. Banks decide which correspondent relationships are worth the compliance cost. Payment providers decide which corridors get instant settlement and which get delays. Corporations decide whether to hedge with dollars, euros, or a basket. Here's the mechanism that accelerates the process during shocks. When volatility spikes, risk managers increase haircuts on collateral. Clearinghouses raise margin requirements. Banks pull back credit lines. In that environment, the currency that is easiest to fund becomes the currency everyone wants, and the currency everyone wants becomes scarcer. That is the dash for dollars dynamic. The response from countries outside the privileged liquidity circle is predictable. Build more ways to settle without being forced into the scramble. If you want to tell that this isn't theoretical, look at behavior around gold in 2025. 3 tons. Investment demand surged and prices rose sharply. When both official actors and private investors bid the same neutral asset, it's often because they are responding to the same underlying signal. Uncertainty about the reliability of paper claims during stress. That doesn't mean every paper claim fails. It means the premium on sovereignty and settlement flexibility is rising. And this brings us back to the opening paradox. The dollar can remain the central pillar while the scaffolding around it changes. The more the world builds scaffolding, the less catastrophic it feels to lean away from the pillar. That's why de-dollarization is not a headline. It's a process. And it speeds up exactly when people insist nothing is changing. So how is this process executed? What is the mechanism? Think of the dollar system like a global highway network. For decades, most international commerce could use the same main roads. The tolls were low because the roads were deep, predictable, and universally accepted. But over time, some drivers learned that the highway had checkpoints. Sometimes the checkpoint is sanctions, sometimes it's compliance risk. Sometimes it's a bank pulling back correspondent lines. Sometimes it's a sudden shortage of dollar funding that makes the toll price jump overnight. When the toll becomes unpredictable, the rational response is not to abandon the highway entirely. It's to build side roads. At first, those side roads handle only local traffic. Then they connect. Then they become usable during storms. And eventually, even if the highway remains the biggest route, the network becomes less centralized. In financial terms, the side roads are swap lines, bilateral clearing agreements, regional payment systems, and reserve diversification into assets that don't require another country's permission. Gold is the most obvious, but it's not the only one. The other currencies bucket in COFR is an index of this behavior. It's a signal that central banks are holding more optionality than the standard narrative suggests. And there's a second mechanism that matters just as much: collateral. Modern finance runs on collateral, and the most universal collateral has been U.S. Treasuries. When the system is calm, treasuries circulate globally, and they function like the grease in the gears. When the system is stressed, everyone wants the same thing at once. That's when the privilege of issuing the core collateral becomes most valuable, and it's also when the rest of the world is reminded it depends on access to that collateral market. Now connect this to de-dollarization. If more trade settles outside the dollar, and if more reserves shift toward gold and other assets, the demand for treasuries as universal collateral can still remain huge, but it becomes less monopolistic at the margin. A little less monopoly can mean a lot more sensitivity to policy credibility because the buyer is less compelled by necessity. This helps explain why you can have 2 truths at once. The dollar can remain dominant, and the system can still be de-dollarizing in a meaningful way. The process is not a vote against the dollar. It is a vote for redundancy. So what does this mean looking forward? Historically, when reserve managers diversify and payment networks fragment, a few things tend to follow. First, funding stress becomes more episodic and more regionally uneven. You don't necessarily see it in daily headlines. You see it in the price of hedging. You see it in cross-currency basis moves. You see it when trade finance tightens for certain corridors while others remain liquid. Fragmentation makes it harder for liquidity to flow smoothly to where it is needed, and that can turn small shocks into bigger market reactions. Second, commodity and trade invoicing becomes more contested. The dollar's power has never been only about reserves. It's about how contracts are written and which payment rails clear them. As more corridors build non-USD settlement capacity, you get pressure for more regional benchmarks, more multi-currency contract terms, and more hedging markets outside the traditional centers. That's not an overnight change. It's a steady accumulation of exceptions until the exceptions look like a pattern. Third, the political economy of money shifts. When the world relies on your currency, you can run larger deficits and still find buyers because the rest of the world needs the instrument. As alternatives expand at the margin, that privilege doesn't disappear, but it becomes more conditional. Markets can become faster to price credibility because the set of forced buyers shrinks and the set of optional buyers grows. There are three broad scenarios this pattern suggests, without pretending anyone can name the exact date or the exact trigger. In a conservative scenario, the dollar remains the center of global risk pricing and the primary reserve currency, but the edges continue to diversify. COFR shows slow drift. Gold holds a larger share. Other currencies keep rising. More trade settles in local currencies where it's practical. The system looks stable until a stress test reveals the costs of fragmentation. In a moderate scenario, a sequence of shocks accelerates adoption of alternatives, not because anyone wants complexity, but because complexity becomes the price of sovereignty. Sanctions risk, payment frictions, and regional blocks lead to more settlement outside the dollar and more reserves held in assets that can't be frozen by another jurisdiction. The dollar remains central, but its monopoly on convenience erodes. In an aggressive scenario, the catalyst is not ideology, it's settlement confidence. A moment where access to dollar liquidity is constrained, or collateral markets seize, or a major geopolitical event forces rapid rerouting. In that world, the redundancy that has been built quietly becomes immediately valuable, and the repricing happens faster than most people expect because the infrastructure is already there. So, what should be watched if you want to know which path is unfolding? Watch the boring indicators, watch COFR and the imputed composition because it shows the direction of reserve preference. Watch the other currencies share because it's the fingerprint of multipolarity. Watch the official sector gold flows because they reveal the appetite for non-counterparty reserves. Watch swap lines, clearing agreements, and payment system build-outs because they measure operational readiness. Watch correspondent banking health and cross-border payment efficiency because that's where fragmentation turns into real economic friction. Now, the choice ahead. In every transition, there are two groups. One group argues about headlines, the other watches infrastructure. The infrastructure group understands that optionality is the point. Optionality is insurance. Optionality is the ability to keep trade and reserves functioning when the main highway is blocked. This is not about being smart. It's about being attentive to what institutions do, not what they say. Institutions move first because they must. Retail reacts last because it can. And the gap between those timelines is often the gap between calm and surprise. This is data before headlines, where we decode what matters before it becomes a headline. If this helped connect the dots, you know what to do. The question isn't whether the system becomes more multipolar. The question is whether you recognize the process while it still looks like background noise.